Welcome to Invest Smart Daily, where we use AI to break down the best investing strategies. Today, the 7 best dividend stocks to buy right now for reliable passive income in 2026, even if you're just starting out. These picks are based on strong fundamentals, growing payouts, and analyst forecasts. Stick around till the end for my number 1 pick. Before we jump in, why focus on dividends in 2026? With interest rates stabilizing and market volatility expected, dividend stocks offer both income and downside protection. A $100,000 portfolio at 4% average yield could generate $4,000 per year in passive income, completely hands-off. Let's dive in. Stock number 1. First, Johnson & Johnson, ticker J&J. A healthcare giant with 62 years of consecutive dividend increases. Current yield around 3.1%. Why now? Stable demand for medical products, massive cash flow, and trading below its fair value. J&J currently yields about 3.1% with a safe payout ratio under 60%. With healthcare spending projected to grow 5 to 6% annually through 2030, this is a defensive play that sleeps well at night. Stock number 2. Procter Gamble, PG. Owns brands like Tide and Pampers. 68 years of dividend growth. Yield 2.5%. Recession-resistant consumer staples make this a core holding. PG's payout ratio is around 60%, backed by $9 billion in annual free cash flow. In uncertain markets, consumer staples like this tend to hold value better than growth stocks. Stock number 3. Realty Income, the monthly dividend company, pays dividends every single month, yield over 5%. Focuses on triple net leases with retailers like Walmart. Very stable cash flow. What makes O special is its monthly payouts, perfect for retirees or anyone wanting a steady cash flow. They've raised the dividend 128 times since going public. Stock number 4. Coca-Cola, KO, 62-year dividend aristocrat. Global brand power, 3% yield, and expanding in emerging markets. KO currently offers a solid 3% dividend yield with a payout ratio around 75%. Sustainable thanks to its massive global brand moat. The company generates over $10 billion in annual free cash flow, and with expansion into emerging markets and new healthier drink lines, analysts expect steady 7 to 8% dividend growth through 2026 and beyond. It's the classic buy and hold forever stock for reliable income. Stock number 5. Microsoft, MSFT. Not just tech, now a dividend grower with AI dominance. Yield 0.8%, but massive growth potential. Microsoft might surprise some as a dividend play with its lower 0.8% yield. But the real story is growth. The company has raised its dividend over 20% annually for the past 5 years. Backed by Azure cloud dominance and AI investments through OpenAI, Microsoft is positioned for continued double-digit earnings growth. This makes it perfect for younger investors who want both growing dividends and capital appreciation in one holding. Stock number 6. Schwab U.S. Dividend Equity ETF, SCHD. Want instant diversification? This ETF holds top dividend companies with a rock-bottom expense ratio. Yield 3.6%. SCHD gives you instant diversification across 100 top dividend-paying companies with a tiny 0.06% expense ratio, one of the cheapest in the industry. Current yield sits around 3.6%, and it has a strong track record of outperforming broader markets during downturns while still capturing upside. For beginners who don't want to pick individual stocks, SCHD is often called the set it and forget it dividend ETF. Just buy shares regularly and let compounding do the work. Finally, my number 1 pick. Visa, the payments network with near monopoly status. Yield 0.8%, but dividends have grown 20% annually. As digital payments explode in 2026, Visa wins big. Visa operates one of the widest economic moats in finance, a near duopoly with MasterCard and global payments. Its dividend yield is modest at about 0.8%, but the company has increased payouts over 16% annually for the last decade. With cashless transactions expected to surge in 2026 and beyond, especially in developing countries, Visa profits from every swipe without taking credit risk. This combination of safety and growth is why many consider it the best long-term compounder in the payments space. These 7 can form the foundation of a passive income portfolio. One quick strategy: aim for a balanced dividend portfolio. Combine high-yield names like Realty Income with growth champions like Visa and Microsoft. A simple rule many use is the 4% rule for income. Once your portfolio hits 25x your annual expenses, you can live off dividends alone. Start small, dollar-cost average, and reinvest the dividends. Final tip, don't put all your money in at once. Dollar-cost average over 6-12 months. Turn on dividend reinvestment, DRIP, to compound faster. Over time, this snowball effect is how ordinary investors build real wealth. Remember, this is not financial advice. Always do your own research. Which stock is your favorite? Comment below. Subscribe and hit the bell for more AI-powered insights every week. See you in the next one.